In the previous examples, we assume the holding company owns all the shares in the subsidiary company. Most of the time, however, the holding company owns most but not all the shares in the subsidiary company. The remaining shares are owned by what we call non-controlling interests, which are equity in a subsidiary not attributable directly or indirectly to the holding company. So for example, the holding company owns 75% of shares in the subsidiary company. The remaining 25% of shares belong to the non-controlling interests. These shareholders own shares in the subsidiary but does not have control over it. Non-controlling interest is presented in the consolidated balance sheet within equity, separately from the holding company's equity. Let's go through an example to see the accounting procedures for non-controlling interests. In this case, Company A owns 75% of shares in Company B. Company B's net profit for the year is $184,000. I will explain the relevance of the subsidiary's net profit for the year laterwards. Let's eliminate the investment in subsidiary account first. The consolidation journal entry is debit share capital, debit reserves, debit retained earnings, debit or credit goodwill, which is the plug figure to force the debits to equal the credits, and credit subsidiary. But by how much? When we debit share capital, reserves, and retained earnings, it is based on the portion that belong to the holding company, meaning we must multiply it by the percentage of shares the holding company owns, like this. The amount to credit for subsidiary is always the subsidiary line item in the holding company's account, which is 1 million. Then, we notice we need to debit goodwill by $66,250 to force the total debits to be equal to the total credits. Now let's move on to record the non-controlling interest. There are two parts to this. First, recognizing the portion of the subsidiary's net profit which belongs to the non-controlling interest. That's why I mentioned the subsidiary's net profit for the year. Second, recognizing the portion of the subsidiary's equity which belongs to the non-controlling interest. Let's do the net profit first. The consolidation journal entry is debit non-controlling interest income statement and credit non-controlling interest balance sheet. But by how much? By the proportion of net profit that belongs to the non-controlling interest. If the holding company owns 75% of shares in the subsidiary, then the non-controlling interest owns 25% of shares in the subsidiary. So that is 25% multiplied by $184,000. Next, recognizing the portion of equity that belongs to the non-controlling interest. A word of caution here. The amount of retained earnings that will be attributed to the non-controlling interest is the beginning retained earnings. So we must subtract the current year net profit from it, because we have already recognized the current year net profit earlier on. The beginning retained earnings is $781,000. The consolidation journal entry to attribute equity to non-controlling interest is debit share capital, debit reserves, debit retained earnings, and credit non-controlling interest by the proportion of non-controlling interest over each line items, like this. Here's another word of caution. I understand the consolidation journal entry to eliminate the subsidiary account and to attribute non-controlling interest is quite similar, but I need you to note something quite important. When you eliminate the subsidiary account, you always use the figure on the date of acquisition, but when you attribute non-controlling interest, you always use the current year figure. So let's say this is year 5's balance sheet. Company B earned $67,000 net profit for the current year. And this is Company B's equity balance on the date of acquisition, which is derived from the figure in the previous slide. The consolidation journal entry to eliminate the subsidiary account is debit share capital, debit reserves, debit retained earnings, debit or credit goodwill, and credit subsidiary. And the figure to use in the calculation is the balance on the day of acquisition. To attribute the current year net profit to non-controlling interest, we always use the current year net profit. So we will debit non-controlling interest income statement and credit non-controlling interest balance sheet. Take 25%, multiply by the current year net profit of $67,000. Before we attribute the subsidiary's equity to the non-controlling interest, we must compute the retained earnings at the start of the year. Then we will debit share capital, debit reserves, debit retained earnings, and credit non-controlling interest. Which figure do we use? The current year figure, not the figure on the acquisition date. Earlier on, I mentioned that in computing goodwill, we will take the difference between the cost of investment and fair value of net assets acquired. Yes, the holding company will measure the identifiable assets acquired and the liabilities assumed at the acquisition date fair values. Fair value refers to the money received to sell an asset or money paid to transfer a liability in an orderly transaction between market participants at the measurement date. Please note that when I say identifiable assets acquired, it refers to both tangible and intangible assets. On a company level, we do not recognize intangible assets, but in a business acquisition, we will recognize the subsidiary's identifiable intangible assets separately from goodwill. The holding company will recognize intangible assets if it fulfills these two criteria. 1. It is probable that the expected future economic benefits that are attributable to the asset will flow to the entity. 2. The cost of the intangible asset can be measured reliably. Some examples of intangible assets may include brand names, computer software, licenses, intellectual property rights, trade secrets, and other intangible assets under research and development. What if the subsidiary's assets or liabilities are not fair value? What would the consolidation journal entry be in such cases? Let's assume Company A owns 75% of shares in Company B. Company B's net profit for the year is $55,000, and this is Company B's equity balance on the acquisition date. We also note that the property, plant and equipment is not measured at fair value. It is undervalued by $100,000. To eliminate the subsidiary account, the consolidation journal entry is debit share capital, debit retained earnings, debit property, plant and equipment to increase the value of the property, plant and equipment to its fair value, debit or credit goodwill, and credit subsidiary. The amount to debit for share capital and retained earnings is 75% of the balance at acquisition date. The amount to debit for property, plant and equipment is 75% of the undervalued amount. We will always credit subsidiary by the amount presented in the holding company's balance sheet and insert a goodwill figure to force the total debits to equal the total credits. Next, we will attribute the current year net profit to the non-controlling interest. The journal entry is debit non-controlling interest income statement and credit non-controlling interest balance sheet by 25% of the current year net profit. Before we attribute the remaining equity to non-controlling interest, let's compute the beginning retained earnings of the subsidiary, which is $1,245,000. To attribute equity to non-controlling interest, we debit share capital, debit retained earnings, debit property, plant and equipment, and credit non-controlling interest. We debit share capital by 25% of the current year's share capital balance, debit retained earnings by 25% of the beginning retained earnings, and debit property, plant and equipment by 25% of the undervalued amount.